All right. Good evening to everyone. My name is James from Varsity Unlimited Tutors. So I'm just gonna take maybe 5 minutes of your time to just introduce myself and what I do so that it's clear to everyone, and then we can proceed with the business of the day. So Varsity Unlimited Tutors is just a company, just like any other company, but we specialize in tutorials in assisting students. So each and every year, each and every semester, we assist our first-year students and our advanced diploma students and postgrad students, those three main groups, with tutorials for the different modules that they are conducting, specifically accounting, business finance, microeconomics, marketing, business management, and etc. Right. So that's what we specialize in. Right. So what we usually do is for the first month, for the first 21 days or so, we offer our services for free, where we just go through the introduction units for you to get your bearings. But I understand you are waiting for your university to start the webinars and whatnot. You might not understand a lot of things. So we help you to get your bearings. And then later on, if you are still interested in getting the assistance that we are providing, and then we'll provide you with the fees and whatnot and all of the basics of what we do. But in short, for the whole of February, we will be here for you. Each and every week, we'll be conducting lessons. So today I'm doing business finance. Tomorrow I'll be doing microeconomics. Next week, we'll do business finance, microeconomics, advanced management, marketing. We'll do all of the different modules that we'll be doing. We'll just be going through the introduction, highlighting the definition of terms, giving you some insights into the different aspects of the study guide that you need to know and that are important for your studies at the end of the day. Right. So once that's done, for those that will be interested in continuing to get assistance with us, we do assist with exam preparation. We also assist with the formative assessments that you are receiving. We go through them with you in a class setup like this so that we make sure that you get the best marks possible. Right. So that's basically me. That's James from Varsity Unlimited Tutors. So for today, I want to look at business finance. That's what I want to look at. I want to introduce business finance to you and what business finance is all about. But before I do that, I can take questions if there are any questions that you might have. I can take questions if there are any questions that you might have. I see yes. Sietemba Lamini says that we are not audible. Am I not audible, guys? Or maybe you did not join correctly. Because I thought I was audible. Okay, let me just try to help. Audible. Kindly ensure your mic is turned on. Join with audio or log. Just try to help the guys out that are saying that they cannot hear me. I hope that clarifies that. All right, so I'll proceed, right? So, all right, let me not use these slides here. Let me start from a different perspective. I'll come back to the slides later. Okay. So your business finance, it has got two units that are very, very key for you to understand what we want to talk about. If you miss it in those units, you're going to have a problem later on in terms of what we'll be doing. So that's what we want to focus on. Today, I want to do both units. I'll just do one. And then next week and next week, part one, I'll do the other unit. So today, I just want to have a look at unit number one. Right. Unit number one. All right. Let's see. Unit number one. Okay, so we want to talk about the concept of business finance. Business finance is also known as financial management. That's what business finance is. It's also known as financial management. So when you're looking at the subject of financial management, you are saying, I'm gonna look at you as managers. because this is what it's all about. I'm going to look at you guys as managers at the workplace, right? So as a manager at the workplace, right, you are responsible for certain activities of the company. One of those activities is to do with the financial health of the organization, right? It means that you, as a manager, you need to plan for the finances that the organization is going to need. So you need to plan and say, look, this company that I have, during this coming year, we are going to need to build a factory. We are going to need to pay our salaries. We are going to need to buy some assets. You are going to plan, because for an organization to succeed, there has to be a plan that has been put in place. That's the first thing, point number one. Point number two is you are going to need to direct the individuals that are working at the workplace. You go to your finance manager, you go to your accountant, you go to your cashier, and you need to give them certain responsibilities, certain roles, certain directives concerning the finances of the organization. That, look, can you please put aside 100,000 rand in September, because in September we need to do A, B, C, D. That's you directing. Then you need to monitor the activities of the company, where you're now looking at, look, this company, we gave some people some products, and they said that they are going to pay us back our money within the next 3 months. Have they paid us back that money? If they have not paid us back that money, then that's a problem. But it's your responsibility as a manager to monitor your debtors, to monitor your creditors, so that your organization does not end up having liquidity or solvency challenges. Because you end up in the court. If you do not pay your creditors in time, they're going to sue you, and you're going to end up in a court of law. So as the manager at your organization, part of your role in financial management is monitoring the creditors, the debtors, and the various financial activities of the company, right? And then there's going to be some controlling that is happening. So, for example, if you budgeted during the year that our salaries, we need to pay maybe R1 million in salaries, right? If you are now in September and you have already paid 1.2 million, that's a problem. It means that you hired more people than you were anticipating to hire, and that organization might end up making a loss. So you need to control your activities. You need to control how many people are we hiring. You need to control the overtime that you are paying the employees. You need to control the interest that you are being charged by your suppliers, or the prices that you are being charged by your suppliers. So those are all part of the different activities that your organization is facing on a day-to-day basis that you need to take care of, right? So financial management is all about the planning, the directing, the monitoring, the organizing, and the control of the finances or the monetary resources that exist within an organization. And that's part of your responsibility as a manager at the workplace. It is not only the responsibility of the finance manager or the administrative manager or the accountant. It is the responsibility of each and every manager at the workplace. Because if financial management is done properly, then an organization can achieve the objectives that they've set for themselves. So, for example, let's say that your objective is to achieve a profit of 9 million rand. You're working at ABSA, and ABSA say we want to achieve a profit of 9 million rand in 2024, right? If you do not control your expenses as a sales manager, those expenses are going to be the expenses of the company, right? And they are going to ensure that you do not achieve the objective that the company has set in place. So although the finance manager has tried, but because you as the marketing manager failed to control the number of people that you hired, failed to control the activities in the marketing department, you end up with a marketing budget that is higher than what was anticipated by the finance manager. So it's everyone's responsibility to control the financial or to manage the financial activities of the organization. I hope that's clear. I don't know if there are questions there on what financial management is all about. Right. So there are three key decisions that you are going to undertake as a financial manager, right? There are three key decisions that you're going to undertake, right? These decisions, like I said, I'm going to take you guys as managers. I'm going to use the term financial manager more often, but this too refers to any other manager. If you don't understand it, you can highlight to me. You can give me example, James. On this point, I don't understand. How does this apply to the HR manager? How does this apply maybe to the operations manager? I can tell you how it applies to that manager, but I'm going to use the financial manager typically as an example. Right. So there are three key activities that we're going to do that we're going to learn about. So financial planning, financial control, and financial decision making, right? Financial planning, I've already explained what this is. So this is whereby you look into the future and you decide what will we need in the future. If you are a company such as Vodacom, right? You want to expand as Vodacom, you're going to say, look, as Vodacom, we are going to need some telecommunications infrastructure in the next 10 years for 5G, or maybe there will be now 6G, right? So that's financial planning. So if we need telecommunications infrastructure for us to have 6G in South Africa, the financial manager at Vodacom needs to what? To make a decision right now. How are we going to finance that equipment that we are going to need in the long term? Or number two, maybe simple decision. Next year in 2025, how are we going to pay our salaries? Where are we going to get the money that we are going to use to pay our salaries as an organization? That's financial planning, right? Financial control, I've already explained what this is, right? You've got a budget, you've agreed as an organization that we are going to use this much amount of money. So you now want to check, is this much amount of money being used on a day-to-day basis? That's financial control, right? Or you can look at issues such as fraud. You've got money in the bank account. You as the financial manager, is that money secure within the bank account? Or some of your clerks are stealing the money and fraud is happening at the what? At the workplace at the end of the day. Then also issues such as taxation, right? Are you as an organization paying for your taxes properly? That's also part of financial control for your what? For your organization, right? Then financial decision making. Under financial decision making, there are three key decisions that you are going to make as a manager, right? There's investment decision, financing decision, and dividend decision. Investment decision is you are asking yourself the question of what should we invest our money in, all right? So think of it again this way. Let's say that you want to start a business and you have 100,000 rand. You want to start a business, right? So that 100,000 rand, you can start maybe, you can do shoes. You can start a manufacturing plant where you do shoes. Or you can do clothes, right? It's a business. You can open a shop where you sell computers. It's a business that you can do. There are different types of businesses that you can do with 100,000 rand, right? But which one do you take? That's what is called an investment decision that you have to make as a manager, which means you need to assess the business of manufacturing shoes, the business of manufacturing clothes, the business of selling computers, the business of selling cars. Which of these businesses will be better for me? That's part of the decisions that you have to make as a financial manager, right? So we are actually going to do topics, different topics, which will cover some of these areas. Topics which will cover financial planning, where we're going to do budgeting. Topics which will cover financial control, where we're going to do ratios. Topics which will cover investment decision making, where we are going to do capital and investment budgeting and whatnot, right? Then I said three decisions: investment, financing, and dividends. Financing decision is you're asking, where do I get the money? Right. Let's say that you decide you want to do a factory where you manufacture shoes, right? And you notice that you need 200,000. You have 100,000, but you need another 200,000. Where are you going to get it? Are you going to get the money from your friend? You go and look for a partner. They also invest 200,000. You share the profits. Are you going to go to the bank and get a loan for 200,000 to start your business? Are you going to talk to your suppliers for them to give you the shoes on credit. How are you going to finance? That's financing decisions. Then dividends decisions. Dividends decisions is you are deciding how to pay dividends. You have made a profit. You made a profit of 1 million. What do I do with the profit that I have made for the organization? Do I eat all of the profit? Do I reinvest the profit back into the what? Into the organization, right? So those are the different types of relationships or decisions that you are going to make within the concept of financial management. I do not know if there are any questions. Are there any questions on what I've just covered? Or it's clear? I believe it's clear, it's fine. All right, so now let's look at how financial management relates with other areas of study, right? So under financial management, we are going to involve the accountants or the bookkeepers of the organization. We are going to involve the economists of the organization. We are going to involve what we call management accountants. We're going to involve tax accountants in the organization, and we're going to involve the auditors in the organization. So those 5 key groups are going to inform us in terms of how do we do financial management, right? So when we're looking at a financial accountant, right? When you're looking at a financial accountant, you're looking at someone who we call a bookkeeper. A bookkeeper is someone who does record keeping, right? They are the organization, let's go back to our company that manufactures shoes, right? So they need someone to record the sales. We have sold 10,000 Rand in shoes today. They need someone to record the expenses. We have paid 500,000 to our suppliers today, right? They need someone to prepare the financial statements. How much profit did we make? How much loss did we make at the end of the day? So that's a financial accountant, someone who's just responsible for the record keeping within the organization, right, of the accounts of the organization. Then an economist on the other side is someone who's responsible for making production decisions. So you will notice when we start on economics, I think when we do the unit on production, I'm going to tell you this organization, for them to make the maximum profit, they should produce at MC's cost, MR, marginal revenues, cost to marginal cost. That's economics. So an economics can tell you how much to produce in order for you to make the maximum amount of profit. They can tell you the different types of opportunity cost, explicit and implicit costs that will be faced by the organization. They can tell you whether to increase your price or to decrease your price, depending on the elasticity of demand or the elasticity of supply, so that you know whether you make a profit if you increase your price or you make a profit if you offer discounts. That's the job of the economists. They will also tell you of issues such as, with the current increase in the interest rate, we can borrow more money and the organization will be okay. Or with the inflation rate and the exchange rate, maybe we should stop exporting, or maybe we should export to the outside market and we'll make a profit. So that's the job of the economist. So that's how the economist is involved in decision-making within the company. So you'll notice that when companies are smaller, they might not have economists, but as companies grow bigger, you know, the likes of Vodacom, the likes of FNB, and all of these big companies, if you go in them, you notice that they will have economists, because the economists have a different perspective about decision-making, which is very, very useful for you as a financial manager at the end of the day, because they can tell you how to price your products. They can tell you the quantities in terms of production. They can tell you which markets will work and which markets will not work. They can even tell you about competitors, how to deal with your competitors. Economists, they have that ability to tell you how to deal with your competitors, because they can tell you the market structure in which you're operating and the conditions of that market structure and how to implement that within your decision-making at the end of the day. Right? So efficient use of business resources is the purview of the economists. Right? Management accountants. Management accountants now, these are very similar to financial managers. But a management accountant is someone who takes financial information and makes decisions out of it. Right? So this is the type of person who is going to do your costing, who is going to analyze all of the different costs that you have, all of the different prices that you have, and will be able to tell you, look, we are losing money here as an organization because of this product. It's not giving us enough profit. there is no marginal income that is commensurate to what we want to do. These are the guys that also do budgeting. Your cash budgeting, production budgeting, and whatnot. It usually comes from your management accountants of the organization. So they are so very much linked to financial management, because it's really part of what they critically do at the organization, right? Then you've got your taxation, your tax accountants. These are make sure that you are adhere to the rules and regulations of the nation. Because remember, if you do not pay your taxes, SARS is going to sue the organization, your company is going to be closed down. So your tax accountants also come into management accounting, because they will also help you to ensure that you are adhering to the various regulations of the country, right? And then lastly, your auditors are looking at your financial control. They're looking at your systems of control that have been put in place in the organization, and they're also checking to see that there is no fraud that is happening within that specific organization, right? So that's the key things, key relationships, so to say, that you need to know about with financial managers. They have a relationship with financial accountants, economists, management accountants, tax accountants, and your auditors in the company. I don't know if there are any questions here, or this is clear. It's just theory. I don't think there's much to it. All right, we go to the next one, which is the goals of financial management, right? What are you trying to achieve as a manager at the workplace? The main goal of any organization is to make profit. You do not go into business without the intention of making profit. Whatever business that you start, the idea is, I want to make profit, right? I want to make profit. But however, the idea of profit making itself, we usually call it a short-term goal. We usually call it a short-term goal. Why are we saying a short-term goal? Because if you focus too much on making profit, you can make a lot of profit in the short run, but in the long run, you might notice that your business becomes unsustainable. Because for you to make profit, you have to have more revenue and less cost. So which means that you might have to overcharge your customers, and you might have to underpay maybe your employees or your suppliers. So over time, your customers might move to people that are cheaper. Your employees might move to organizations that pay better, and you lose out. So profit maximization, although it is the majority goal of all organizations, it is usually referred to as a short-term goal that the organization has, right? One key goal that we can talk about is what we call rate of return maximization. Rate of return maximization is you're saying that I invested some money into the company. I need to get the maximum amount possible from my return. So if I invested 100,000 rand, if I'm saying that my goal is to maximize the rate of return, I'm saying that from the 100,000 that I invested, I want to increase the returns. If I'm getting 10,000 per year, it means I'm getting a 10% return. I want my return to be 20%. I want my return to be 30%. So that's an intermediate goal. Why? Because most of the time, you're not able to fully realize the money that you invested within 1 year. Most of the time, you invest money into the organization, it can take you 3 years, 4 years, 5 years to get that money back. So that's intermediate. So your goal is to return your money back, but as fast as possible. So that's why it's maximizing the rate of return, right? We're going to talk about the payback period and whatnot later on during the semester, right? Then your third goal is going to be maximizing the value to the shareholders. Now, this is the most important goal that you have as an organization, because there is someone who owns the organization. Whether it's you, the manager, or it's someone else, there is someone who owns the organization, who is the owner, the person who invested money for the business to start. Your role as a manager is to make sure that over time, the wealth of the owner of the business is increasing, right? This year, you can make a loss. It's still fine. The owner will not be angry with you. As long as you can show the owner of the business that we need to make a loss in the first 2 years, so that in the next 20 years, I can increase your wealth by 200%. or your wealth by 300 million. So shareholder wealth maximization is a long-term goal where we increase the value of the company over time, and the value of the company will equate with the wealth of the original shareholder of that specific organization. So those are the three goals. Whenever you're operating a company, you've got three goals: profit maximization, short-term; return maximization, medium-term; and wealth maximization, which is the long-term goal, which is the long-term goal. This one, we've talked about it: functions and roles of a financial manager. I've already discussed this one. I don't think I need to go too deep into it, right? We said that a financial manager makes decisions about investment. Where do we put the money? Should I invest the money in a factory? Should I invest the money in an Uber business? Should I invest the money in an export business? Financial managers make financial decisions, right? Where can I get financing for the organization? Should I go to the bank? Should I look for another partner for the business? Financial managers, one of their roles is to make sure that the business is profitable. Are we making a profit? Do we have cash as a business to pay our suppliers, to pay our customers, to pay our employees for the organization? Are we not in too much debt as an organization? That's solvency. Solvency is talking about debt. Are we not in too much debt as an organization? Because debt means that the creditors can take your company away from you as an organization, right? So these are some of the key roles that a financial manager plays. I'm not going to go too deep into that, right? I think I'm left with two things that I want to talk about here. Let's see. This one we touched on it a little bit, but it's the principles of financial management. So when you're making decisions within an organization, there are certain guiding principles or a certain mindset that you need, right? There's a certain mindset. So this mindset depends with the organization that you're operating with. So for me, for example, I have had the fortune of operating in an investment setup. It was Standard Chartered. I'm sure all of you know Standard Chartered. Then I had the opportunity of working in an insurance setup where we did cost benefit. So in an investment setup, you do risk-return principle. In an insurance setup, you do a cost-benefit analysis of what you're trying to do at the end of the day. Then time values, it applies to everyone, but usually it applies to organizations like banks. I also did work in a bank. We did a lot in terms of time value of money concept. But these principles, what we are saying is this. When we're saying the cost-benefit principle, we're saying the decision that you are making as an organization. What will be the cost to the organization? What will be the benefit to the organization? So for example, if you decide as an insurance company that you want to go and maybe finance a football team, right? You know, a local football team, soccer team, right? You want to finance that. There's going to be a cost because you need to buy jerseys for them. You need to maintain their ground. You need to give them food, bars for their trips and whatnot. But what benefit will you get as an insurance company from that corporate social responsibility activity that you're undertaking, right? So maybe the benefit will be exposure of your brand. You get goodwill with the community. People like your brand more, which means that they are more likely to join the insurance company than joining other insurance companies. So that's a cost-benefit principle, right? Risk-return principle is you're looking at, for example, when we're in investments, we would assess the stock exchange. So you would look at, we've got $100 million US. It was a US dollar country where I was working, $100 million US, and you're looking, can we invest this in Vodacom shares, or should we invest in MTN shares, or should we go and invest maybe in JP Morgan shares on the US stock exchange, right? So when you're making the decision, now it's a risk return. You're now looking at what are the current returns of the Vodacom share, what are the current returns of MTN, and what are the current returns of JP Morgan shares. And then you compare that against the risk of that specific organization. If I invest in JP Morgan Chase, you look at the risk profile, the standard deviation of returns, you look at the Sharpe ratio or the Tresson ratio, you look at those ratios, and then you see if the risk return principle says that there's a benefit there for you, then you go ahead with it. The higher the return, usually the higher the risk. The lower the return, usually the lower the risk that you have. So you have to look at that principle for you to be able to make a decision as an organization where to invest your money. Because some investments will be more risky than other investments, but they might also provide a better return than other investments, right? Then lastly, the time value concept. This one is straightforward. Even you yourselves, you apply this. If I ask you right now, can I give you 10,000 Rand today, or can I give you 10,000 Rand in 2 years' time? All of you are going to say, give me today. Why? Because you know that 10,000 Rand in 2 years is not worth 10,000 Rand. Straightforward example, 10 years ago, you could buy bread for 8 Rand, 7 Rand, somewhere there. But right now, you have to buy bread 15 Rand, 16 Rand, 17 Rand. It means that the money is losing value over time. So that's the time value principle. So you're saying that as an organization, if you've got one project which promises to give you returns in the next 2 years, and you've got another project which promises to give you returns in the next 20 years, you are likely going to choose the project which gives you returns in 2 years. Why? Because of the time value of money concept. Because the money is safer and it is more valuable to you because it is being retained within a reasonable amount of time. So that's the time value of money concept. So some of these concepts will go deeper into them when we go through the study guide. I'm just giving you a generic background of what it is all about. So I think this should be my last thing. Yeah, that should be my last thing. The agency theory, right? So when we are looking at a manager within an organization, a manager is not always the owner of the business. Sometimes a manager is the owner, but is not usually the owner. So if I start my business right now, right, I invest money in the business, I can hire people to come and work for me. Right? I myself can work at the company, but sometimes I might have other things that I want to do. So I can hire managers to work for me. So a manager is the person making the decisions that will result in the success or the failure of an organization. But they are not the owners of the organization. They're getting a salary. So that creates problems. Because remember, the manager is the one in charge of decision making. He's the one who is making sure that the organization succeeds or the organization fails. But with so much power, how do we ensure that the manager is not going to steal the business, that the manager is not going to disappoint us in managing that specific business? So that is what is called the agency theory, where we are saying that the owners of the business, they appoint managers for the business. And there needs to be a proper relationship between ownership and control of the business, i.e. the manager needs to ensure that whatever decisions that they are making, they have a moral obligation to make sure that these decisions will result in shareholder profit maximization. And they're just not making decisions of increasing their salaries and all of those things, buying themselves expensive cars, luxurious cars, while the business is failing. They have to make decisions that are for the betterment of the company and henceforth the what? The shareholder of that specific business, right? So that is unit number 1, where we are talking about the what? What is financial management? I'm going to ask you guys if there are any questions, but before I ask you, I just wanted to highlight a couple of things again. All right. So under unit 1, we just did theory. So it was very straightforward. You can see we just did 30 minutes and we were done. The next unit that we are going to be doing is going to be unit number 2. Unit number 2 will take us probably 3 weeks because it has a lot of information in it, right? So under unit number 2, we are now going to do the actual preparation of the financial statements. So there are 3 financial statements that I need to teach you guys how to prepare them. That's why I'm saying it's going to take us 3 weeks. We're going to do income statement next week. The week after that, we do the balance sheet. The week after that, we do the cash flow statement, right? So these are typical exam questions. In each and every exam that you guys are going to do, right, there is either going to be an income statement, a statement of financial position, or a cash flow statement. Either one of these 3 things will be within your exam. So I need to teach you properly because it's a little difficult, but I'm sure we will be able to manage it. I'm sure we will be more than able to manage. So that's what will be our focus for the next 3 weeks. So for each lecture that we do for the next 3 weeks, please bring in your calculator and bring in maybe a notepad so that you can take notes, or if you have questions, you can take note of the questions that you have, and then you can ask them so that I can explain these things for you. All right, so that's I'm done for today. Are there any questions for me?
Hi, James.
Yes. How are you?
I just want to know, would you be able to go through the think points with us just to see if we manage to understand them correctly and we answer them correct?
To go through what? So can you repeat that point? To go
The
through what?
think point.
Okay. Yeah, we definitely can do that. We definitely can do that. It's not a major problem. Any other questions other than that one? All right. If no questions, let's just go quickly through the think points. Where were we? All right. The first thing point says here, if you were given 1,000 Rand and only 2 choices to do with the money, the first choice is deposit it into a notice account that earns an interest of 8 Rand a month. The second choice is bet on a horse race for Vodacom July race, where there is a 16% chance of your horse winning the race. If your horse wins, you collect 4,000 Rand. What would be your choice? So this one was on the principles. Remember, we said that there are 3 core principles: cost benefit principle, risk return principle, and the time value of money principle. So he's actually asking you, how do you apply the principles that we have talked about? Anyone with a thought? You've got 2 options: 1,000, either invest in 8% interest per month, or go and bet the money and get 4,000. There's a 16% chance of winning. Anyone with a thought? What should we have done? There's no right or wrong answer. It's just a thought. It's a think point. That's what's called a think point. There's no right or wrong answer. Anyone want to try? Yeah, you're too quiet, you guys. But I'll forgive you for today. But when we do the calculations, I'll need you guys to participate. Right. So what he's basically saying here is that, think of it this way. There is a return. You have 1,000. The first option has got a return of 8 Rand deposit. What is the risk associated with 8 Rand? There is no risk here, because if you put 1,000 in a bank, you are going to get to 8 Rand return every single month, guaranteed. So there's no risk here. There is return, but there's no risk. But the return is very small. It's only 8 Rand. But the second option, this 1,000 Rand, you only have 16% chance of winning, which means that you have got 84% chance of losing this money. But the return is 4,000 Rand. So the risk is very, very high, but the return is also very, very high. So this is what I was talking about, that usually when you've got a high return, you also usually, it's associated with a high risk, whereas low returns are associated with low risk. So now for you to make a decision, it now depends on your risk appetite. What type of risk appetite do you have as an individual? For those of you that have got a high risk tolerance or a high risk appetite, you are going to take the decision of the betting. But for those of you that have got a low risk appetite or a low risk tolerance, you are going to take the decision of investing in the fixed deposit account, because you are applying the risk return principle. That's basically it, right? So again, same concept here. Suppose you had 2 million rand in your bank account and had to choose between giving another 1 million rand today and being given 1 million rand next year. What would your choice be? I already gave you this example. Getting the 1 million rand today is better than getting the 1 million rand next year, right? Because if you get the 1 million rand today, it means it has not lost any value. But if you get it next year or after 2 years, it will have lost value because of inflation. So you definitely going to choose the option with what, which maintains the value of your what, of your money at the end of the day, right? I think point number 3, the compensation of ABC Limited CEO includes 1.5% of ABC's profits for the year. Suppose the CEO is able to influence the official responsible for the preparation of the financial statements. Will the CEO of ABC Limited be tempted to ask the official preparing the financial statements to inflate the profits? Yeah, the temptation will be there. But this is, remember, we're talking about the agency theory. The temptation will be there. Right, you are the CEO of the company. You know that if the company makes profit, I get 1.5% of the profit. If the company makes a loss, I don't make any money. So, of course, you would want the company to make profit. So you would go to the person preparing the statement, hey, can you make sure that we have a profit? Right? But this is not ethical. This is where the agency theory comes in now, where we're highlighting that a manager should have the moral obligation, right, to say that I am the manager of this organization. I should make sure that everything that is done is above board so that both me and the owner of the business succeed, not only you alone as the manager of the what, of the business. I think that's it. All right, I think that's cool. Anything else before we dismiss each other? All right, if there's nothing else, I'm going to send the link tomorrow for economics, because we are going to be doing economics tomorrow, Tuesday. I'm going to send the link for economics tomorrow in the morning for those of you that are interested in joining through for economics. I hope you enjoyed yourself. Like I said, I charge for my services. I don't want to lie about that. But for the month of February, everything that I'm going to be doing will be free. So feel free to join for the whole month of February. If after the month of February you're still interested, I will tell you what my prices are and then we can talk. But for the month of February, feel free to join. We'll go through the first 2 or 3 units just to help you pick up your pace so that by the time you start with Mankosa, you are already ahead. You already know what we're talking about. It will make your life easier for you at the end of the day. Good night, guys. I hope you enjoyed the session.
Thank you. Bye.
Bye-bye.
Thank you. Bye.
Thank you. Bye.
Bye.
Thank you. Bye.
Bye-bye.
Thank you. Bye.